Hello everyone, I was recently thinking about the ways we can grow a small sum of money into bigger and bigger amounts with a small portfolio. When we think of Warren Buffett, we think of investing billions of dollars for a massive portfolio. In fact, Warren's portfolio is bigger than the 5 next biggest super investor portfolios combined. But he didn't start off this way. And Buffett was actually asked about growing small sums of money all the way back in 1995. And here is what he said.
Recently at a talk at the Wharton Business School, Mr. Buffett, you indicated that you were talking about the problems of compounding large size, which I appreciate and understand. But you indicated, you're quoted in the local paper as saying that you are confident that if you were working with a sum closer to $1 million, that you could compound that at a 50% rate. For those of us who aren't saddled with the $100 billion problem, could you talk about what types of investments you'd be looking at and where in today's market you think significant inefficiencies exist? Thank you.
Yeah, I think I may have been very slightly misquoted, but I certainly said something to the effect. But I think I talked about this group I get together every 2 years and how I poll that group as to what they think they could compound money at it with 100,000, a million, 100 million, a billion, and other types of sums. And I pointed out how this group of 60 or so people that I get together with every couple of years, how their expectations of return would go very rapidly down this slope. It is true. I think I can name a half a dozen people that I think could compound $1 million, or at least they could earn 50% a year on $1 million, have that as an expectation, if they needed it. I mean, they'd have to get their full attention to be working on the sum. And those people could not compound money, 100 million or a billion, at anything remotely like that rate. I mean, there are little tiny areas which, if you follow what I said on the screen there on that Adam Smith's interview a few years ago, if you start with A, and you go through and you look at everything and you find small securities in your area of competence that you can understand the business, I think you can, and occasionally find little arbitrage situations or little wrinkles here and there in the market. I think working with a very small sum, that there is an opportunity to earn very high returns, but that advantage disappears very rapidly as the money compounds, because from $1 million to $10 million, I would say it would fall off dramatically in terms of because there are little, you find very, very small things that you can make, and you're almost certain to make high returns on, but you don't find very big things in that category today. I'll leave to you the fun of finding them yourselves. I mean, it'd be terrible to spoil the treasure hunt. And the truth is, I don't look for them anymore. Every now and then I'll stumble into something just by accident. But I'm not in the business of looking for that. I'm looking for things that Berkshire could put its money in, and that rules out all of that sort of thing. Charlie?
Well, I would agree, but I would also say that what we did 40 or so years ago was, in some respects, more simple than what you're going to have to do.
Right.
We had it very easy compared to you. It can still be done, but it's harder now. You have to know more. I mean, just sifting through the manuals until you find something that's selling at 2 times earnings, that won't work for you.
It'll work, it's just you won't find any.
One of the first main takeaways for this interview on growing smaller portfolios is that actually super investors have a harder time than us when investing money. They can't just invest in the same companies that we can. They're actually restricted by a number of things. Now, these restrictions include from owning only certain percentages of overall companies to not appear like monopolies, or to actually invest in their fund overall. Additionally, they're limited by the market cap and overall size of a company. They can't just invest their entire portfolio into one stock because they believe it would do well. Warren is actually saying that some people could grow these small amounts below $1 million by 50% if doing it the right way. Now, what is the right way? Well, he's saying to invest in smaller companies or securities within your area of competence. Now, many investors find safety and security in investing in bigger companies that super investors are also investing in. And that's because they would probably say there is less risk associated with these investments, and because they get reassurance that big names like Warren Buffett are holding the stock as well in times of hardship. And I probably agree with that sentiment. However, if you are familiar with maybe a smaller company, say around the mid-cap range, then Warren says that this may hold more potential than these bigger companies in terms of overall share price appreciation and growth of the company. So if we unpackage that a little bit with a smaller company, take for example Texas Roadhouse in my portfolio, this would be a poor investment for the likes of Warren Buffett and other super investors. The main reason being the market cap of the company overall is sitting at $11 billion. That means it sits around about 4% of Warren Buffett's entire portfolio, and he would actually be buying or acquiring the entire business. Effectively, he would own Texas Roadhouse. So super investors like Warren Buffett can't just invest in these smaller companies, and they can't have significant weighting in terms of their overall portfolio into these companies. He would have to invest in dozens of smaller businesses just to reach a rate of return and overall affect his entire portfolio, which just isn't really feasible from a risk perspective. So essentially, these bigger investors have to focus on bigger companies, which limits their overall strategy and investments they can make. We don't face this problem dealing with small amounts of cash, so there is our advantage. We have a widened options for investing overall against these super investors. In fact, smaller companies can actually grow quicker than these mega cap companies and grow your investment as a direct result of that. So I believe this is what Warren is talking about when he says there is more potential for higher returns in smaller sums of money. A company like Texas Roadhouse could maybe double in its market cap to sit around $22 billion. And that would happen and the market wouldn't even blink an eye. That's perfectly possible with the size of the population in the US, the number of stores they have, and with some maybe international growth. Actually, when I bought into this company, it sat around $8 billion in market cap. Meanwhile, for a company like Apple to double in terms of its revenue alone, it would have to produce over $700 billion in the year of 2025, which is quite difficult to do when they already have the lion's share of sales for the smartphone in the world. After all, there's only so much money and people in the world. Now, it doesn't mean that these big companies can't grow and grow rapidly. It just means that as companies grow and mature, their chance for rapid percentile growth reduce because they need to raise more and more money each year to match the previous year's growth in terms of percentages. So it can't happen forever. There has to be a slowdown eventually. However, this doesn't take into account additionally the risks that are associated with smaller companies and owning them. So we have to weigh that up as investors. Do we want to invest in smaller companies where there's more risk but more chance for that growth? And as Warren talks about, investors can often find irregularities or wrinkles in the market that they can exploit. And this is focusing on the uncertainty or incorrect valuing of a company by investors due to maybe industry or company issues that don't really affect the fundamentals of the business and its performance. So a good example of this might be Alibaba right now. This company currently trades for 10 times price to free cash flow and is historically undervalued, with its enterprise to operational cash flow sitting around 5 times. So that means you're currently getting around 10% operational cash flow yield at the share price right now, which is almost unheard of for a high quality business like Baba. And that's because the wrinkles that are associated with this business include the US to Chinese relations, which don't look great, Chinese government regulation, which looks quite harsh, and overall maybe just being outside the US, which some customers and investors probably find unsettling. So, certain investors will not invest in this company and not create a stake in the company because they don't like the uncertainty that it offers. But if we are solely looking at the yield and fundamentals of this company, then we're actually getting quite an undervalued stock at a very good price. Now, when I look at my portfolio, I invest in a lot of mega or large cap companies and are actually underrepresented in mid or small cap companies. I have just two, that's Vici Properties, sitting at around about over 30 billion, and we have, of course, Texas Roadhouse, which sits around 11 billion. Now, that's personally because I think my risk tolerance and my area of competence doesn't really extend to these small cap companies. And my assessment of their moats is usually actually found to be lacking. Whenever I look at a small cap company, I worry about their cash position and their ability to grow in the future, because appealing to the consumer is quite difficult and people can be quite fickle with trends and maybe just suddenly stop using a company. And that's what I worry about when I'm investing my money. But I certainly maybe should consider these companies in the future, as Warren Buffett certainly puts value in them. So maybe that's one for me to look into. As always though, thanks for watching guys, I appreciate it, and I'll catch you in the next one.